Hi, I'm April Lois from Investor Relations at Wilson Asset Management. Today I'm joined by two members of the Income Maximiser investment team. We have Matthew Haupt, Lead Portfolio Manager, and Damien Boey, Portfolio Strategist. WAM Income Maximiser is the only Australian listed investment company that invests in both debt and equity. Shareholders, when you invest in Income Maximiser, get exposure to debt markets, wholesale debt markets that otherwise are not available to retail shareholders, plus a monthly franked dividend. Matt and Damien, thank you for joining.
Thank you.
I'd like to start by getting your high-level view on debt and equity markets and a bit of an update on the portfolio. Damien, would you like to kick us off?
Sure. So the thing that is unusual about markets at the moment is that debt is actually a driver of risk appetite and sentiment. It's not necessarily a defense against markets having a risk-off phase. So what that means is that when equity markets are going up, usually what you find is that bonds are going up or their yields are going down. So this is a pretty good environment when you have inflation coming off and central banks are all easing. It becomes a more tricky environment to navigate when inflation is elevated or accelerating. So we're right now in a more tricky phase where inflation is sticky towards the top end of what central bankers are comfortable with. And what that means is that we should expect to see days where bonds sell and stocks sell as well. And so the trick here is really to find a place where you can get good returns and diversification when that sort of dynamic is happening. But certainly inflation is one of the things that we're very interested in, understanding the journey and how central banks decide to respond to that.
Yeah, I'd just add as well, we think equities look expensive and we think debt looks expensive from a credit perspective too. So overall, I think the overall markets are quite vulnerable to a shock, and going into the end of the year, we have some liquidity constraints into the market too, which will put a little bit of pressure, and we're starting to see that at the moment with the bond market sell-off, which Damien pointed to, and the correlation. So, we think we've got to be very active, very nimble, and within this product we are and have the tools to navigate through these cycles.
Yeah, I suppose a good time for active management then. And so Matt, the August 2025 reporting season was dubbed one of the most, or if not the most volatile in history. I suppose, how did you and the investment team handle that, and how was the portfolio performing?
Yeah, fortunately we performed very well through August. It was brutal. If you missed or had some signs of walking away from guidance, you were punished extremely hard. So the difference between the winners and losers is probably the highest we've seen in recent history. How do we position? We, fortunately, through the process we have within WMX, we have a refined equity screen, which really weeds out a lot of the companies which don't have the balance sheets or don't have the robustness around the business model to facilitate going to shock periods. So fortunately for us, we go into that higher quality end. So our stocks perform quite well. We did have a few small holdings, obviously, that got caught up. We had a small holding in CSL, but a very small holding. In James Hardie's, we also had a very small holding. But overall, the portfolio outperformed. Our winners were much higher weightings and actually did very well into August. So we're very happy with how we navigated August.
Great, good to hear. Damien, why is WAM Income Maximiser considered an attractive investment vehicle during times of market volatility?
So if you look at the equity market, what is the average volatility of returns that you get in a normal year? You're probably looking at a number of about 15%. That is, every year you could see plus or minus 15% swings. When you blend equity and debt, because debt is a much less volatile instrument, and it doesn't always move in sync with stocks. Sometimes it does, but more often than not it doesn't. You can really bring down that volatility number to basically low single digits. And if you have an active management overlay, you can actually be generating higher returns with much less risk. So that's really the attractiveness of a product which is active across both debt and equity.
Matt, WAM Income Maximiser aims to deliver a monthly franked dividend, achieve capital growth over the medium to long term, and preserve capital. How has it performed since listing?
Pleasingly, WMX has had a great start to life. We deployed very quickly into the debt market and the Tier 2 market post-Liberation Day when spreads blew out, and we capitalised on that as spreads compressed. Post that, we really tilted the portfolio overweight equities, and within the sleeve of equities, overweight growth to try and capture, because all our signals said central banks had turned dovish. We had some liquidity forecasts saying it was a great liquidity environment, seasonally a very good period. So we really leaned on that and outperformed quite heavily in July, which was a great outcome. And in August, that momentum has continued. So it's really put us in a great position, and it's actually demonstrated the ability of this fund to navigate through these cycles and having all the levers to really navigate and outperform through whatever cycle we face.
You have quite an active and dynamic approach to asset allocation, being debt and equity. Maybe Damien, to start off with, how has the investment portfolio composition evolved since listing?
Yeah, that's a good question. So what we have done when we first got the money in late April and early May is we deployed very heavily into debt. We thought that was the most prudent thing to do. It can often take you a lot longer to get set in debt. And so we did that with a view of getting towards the monthly income target quite quickly. But that was really just about deploying into quite a turbulent market. Then, given the seasonal factors and given what we were observing in terms of how bonds and stocks were moving, given also that a lot of central banks were talking about rate cuts, we pivoted much more heavily into equities. So we were overweight equities at that time. And then within the equity portfolio, we took on a bit more growth exposure than would be normal for us. And that actually worked out quite well. During that time, also what we've been doing is we've been seeing credit appreciate in value. What that means is that the yield starts to go down relative to government bonds, that's spread compression. And we actually got quite a lot of that. And so once we started to see quite a lot of that, we also tightened up the debt portfolio considerably. We invest in investment grade debt, but we pulled it in to basically be the highest quality investment grade debt that we could possibly get, given that we'd already profited from some of the spread compression that we'd seen. In between, there'd been a few trades that we've done in terms of managing the duration or the maturity of the debt book. They've been largely successful. But as we go forward from here, we see risks that central bankers maybe don't cut as aggressively as the market's thinking. That will drive up bond yields and drive down bond values. And we have to think also about how we position within the equity portfolio for that. So we're starting to take a little bit more of a defensive posture into that environment.
Yeah, I think with asset allocation too, when we look at it, we came out and said our benchmark is 60% equities, 40% debt. During Liberation Day, we took a 15% overweight position in the debt portfolio. Through July, we went about 15% overweight on the equity side, and now we are about 10% underweight on the equity side. So you can see it's a very active asset allocation decision. It's just not a balanced fund. This is a highly active fund, and we're looking to take advantage of different regimes.
And Matt, WAM Income Maximiser has a target income return of the Reserve Bank's cash rate plus 2.5%. It's only been 4 months since listing, but how has the dividend been tracking?
Yeah, it surprised us to the upside, which is a good thing to have. Given the performance through deploying into the debt sleeve first and then grabbing the capital growth on the July and through August outperforming as well. So it's put us in a great position where the board have had the confidence to come out and give some guidance. A lot better than we thought. We initially thought it would take within 12 months to get up there. The way we're tracking now gives that board the flexibility to pull that forward. So going really well. The RBA plus 250 is really the minimum income we're targeting from the underlying running yield of the portfolio. The yield from the vehicle, the LIC, can be higher than that. So the way I look at it, that's the minimum we're aiming for from the yield or the income we're receiving from the assets. If we're making capital growth, that obviously goes on top of that. So just to clarify that it can actually be higher than RBA plus 250. That's the minimum we're looking for.
Great. Matt and Damien, thank you for your time.
Thank you.